Investing is partially an art form, but there are numerical indicators that Warren Buffett uses as clues to find great companies. More importantly, though, there are also indicators that he uses as red flags. Grab a drink, take a seat, let's talk about it. I spent hours studying Warren Buffett and the interpretation of financial statements, which is a great book. And there are 7 red flags that Warren Buffett identifies in the income statement. Warren Buffett has a team of investors. Whenever he finds a red flag, what that means to him is we need to look into this a little bit deeper. You and I, we don't have a team of investors. So I find that it's a better use of my time to just move on if there's a ton of red flags that are showing up in a company. That way I start with a pool of companies with the fewest number of red flags, and then I invest in the one that has the best price today. Warren Buffett is famous for saying it's better to buy a great company at a fair price than a fair company at a great price. That's because Warren Buffett prioritizes exceptional companies with a durable competitive advantage, a company that's reliably going to perform better than the market for a long, long time. And the reason he prioritizes quality over value is because Warren Buffett likes to invest for a long time. He wants to buy a company ideally and never sell it. And he likes to do this for a couple of reasons. Number one, compounding works best over long periods of time. Yes. Also, tax efficiency. If you're buying and selling companies within a year, then you're in the short-term capital gains tax bracket, which is your regular income tax bracket. If I'm in the 22% tax bracket, then I'm losing 22% of my profits every single time, which adds up, eating into your compounding over 20 years, 30 years of investing in a huge way. If I'm holding a little bit longer, I'm in the long-term capital gains tax bracket. That's better, but that's still 15% getting eaten up every single time I sell. Now, Warren Buffett, he is in a higher tax bracket, so it works much better for him, but these effects compound for us too over the long haul. This book is primarily focusing on Warren Buffett's 2 most important revelations: how to identify exceptional companies with durable competitive advantages, and then second, how to value these companies. So for now, let's just focus on how are we going to find them. And there's a lot of different ways that we could do that. We could take the qualitative approach. We could look at a company's business model. Warren Buffett likes to focus on 3 different types of business models because they're very reliable, they're really strong business models, and 2, he can understand them. And being able to understand your investments, that's huge. So first business model is a company that sells a unique product. This is really important. It's a huge advantage because it occupies a space in the consumer's brain. Like whenever I'm thinking I want to drink a soft drink, I don't say soft drink, I say I'm going to get a Coke. Even if I'm not talking about Coca-Cola's product, I'm still name dropping Coca-Cola. That's a huge advantage. Same goes for services. That is really difficult for new companies to come in and compete with. It's like invest in companies that are already winning because it's a very safe bet. And the third business model that Warren Buffett loves is the cheapest seller. Who has the economy of scale already in place that allows them to sell products cheaper than anybody else? That's really difficult to compete with because there's lots of investment that you have to put into place before you can even start. It's a big barrier to entry. So for companies like these, think Walmart, Costco, Nebraska Furniture Mart, Amazon. These are companies that sell the stuff that you want for the cheapest, really hard to compete with. Another way, which is the one I'm really excited to talk about, is there are clues in the financial statements that hint that a company has a competitive advantage. And there's also red flags that tell us this company does not have a competitive advantage. So there are 3 types of financial statements that a company releases every quarter to the public, and a big one that they release once every year. So the one that I'm going to be focusing on is the income statement. This is the statement that tells how a company is making its profits. There's also the balance sheet, which talks about the company's assets and liabilities. And then finally, the statement of cash flows, which talks about how much actual cash is coming in and out of the company every year. For this video, I'm just going to focus on the 7 red flags present in the income statement. So in order to find a company's income statement, first, I just Google Coca-Cola SEC filings and I click a link. This is Coca-Cola's filing and reports page. Down here, I have filtered by the form 10K. That's their annual report. And I can just click on their most recent annual report, which is February of 2025. So right here, I've already gone down to the income statement. So this is one option. And Coca-Cola shows the last 3 years, 2024, 2023, 2022. I prefer to use stockanalysis.com. They show the last 10 years if you pay for the premium version. If you just use the free version though, you get 5 years, which is pretty good. So right here, we have the 3 different statements and we have a ratios page. The first thing Warren Buffett looks at on the income statement is the gross profit and the gross profit margin. The way that is found is by taking the revenue and subtracting the cost of revenue. This is also known as the cost of goods sold. So for Coca-Cola's case, how much did it cost them to produce the Coca-Cola versus how much did they make when they sold it? That is your gross profit And Warren Buffett likes to start by looking at the gross profit margin. This is the percentage of revenue that is gross profit. And on stockanalysis.com, I can scroll down to the bottom here and it automatically calculates what is the gross margin. So here I can see 61, 59, 58, 60. These are all really good gross profit margins. And if I look at this excerpt from the book, gross profit margins of companies that Warren Buffett has identified as having durable competitive advantages include Coca-Cola, which shows a consistent profit margin of 60 or better, Moody's, which is 73, Burlington, 61, and Wrigley, which is 51%. In contrast, companies that have bad business models have lower gross profit margin, and he lists a few down here. United Airlines is 14, General Motors 21, once troubled US Steel 17, Goodyear Tire 20. The red flag here is when Warren Buffett sees consistent gross profit margins of around 20% or less. This is a major red flag, and it hints that this company is in a highly competitive market and they do not have the durable competitive advantage that he's looking for, which gives a company pricing power, the ability to up the cost of their products whenever they need to in order to increase their profits. So we're looking at companies ideally that have 60 or better, but a red flag are companies that have 20 or less. The second red flag can be found in the next row down, which is selling, general, and admin expenses. Let me pull over a section of the book. Selling expenses and all general and administrative expenses incurred during the accounting period. These include management salaries, advertising, which is a big one, travel costs, legal fees, commissions, and all payroll costs and the like. This is incredibly important to look at because if these costs are varying wildly, it hints that a company is in a very competitive market. What you want to see here is very consistent and low SG&A costs as a portion of the gross profit. So everything we look at is in proportion to either gross profit or something else. So in this case, I want to know what percentage of gross profit is eaten up by SG&A expense. So if I scroll down here, I see here's a gross profit. And then before we get to the operating income, they are subtracting out the selling, general, and admin expenses. So the red flag here is anything greater than 80%, and if it varies wildly. Unfortunately, stockanalysis.com does not automatically calculate the percentage of SG&A of gross profit. So you have to do that manually. I built an automated spreadsheet where all I have to do is type in the ticker and it does a lot of these calculations for me. So here's ticker Coca-Cola. And if I go to my supplemental page here, I can see SGA as a percentage of the gross profit. Coca-Cola is consistently around 50% and they are consistent. They're below 80%. So no red flags there for Coca-Cola. That's what Warren Buffett is looking for when he's talking about the SGA expenses. The next red flag is research and development expenses. And Coca-Cola does not have any R&D expenses, which is really good. That's actually a good thing. A company that is forced to constantly develop new products is in a highly competitive market. So let me go to a company that I know has R&D. That is NVDA. So let's check out their financials really quick just to see an example of it. So underneath the gross profit, we have SGA, and then we have research and development. So once again, it's not just the fact that they have a high research and development. Yes, NVIDIA spends almost $13 billion in their fiscal year 2025. That is a big expense, but it's important to see what it is in relation to the gross profit. So once again, if I go to my spreadsheet, I can type in NVIDIA and see what is their percentage, NVDA. So as a percentage, their R&D is 13% of their gross revenue in 2025. Now here is an excerpt of Warren's book. Okay, Moody has no R&D expense and on average spends only 25% of its gross profit on SGA. Coca-Cola has none. So here's Warren's rule. Companies that have to spend heavily on R&D have inherent flaw in their competitive advantage and will always have to put their long-term economics at risk, which means they are not a sure thing. Warren Buffett doesn't name a specific percentage that he uses as a red flag. Generally, the lower the better. Personally, I like to use 30%. If a company has more than 30% of its gross profit tied up in constantly having to research and develop new products, then that is a red flag for me. And if I go back to NVIDIA to see where they landed, I can see that for fiscal year 2025 and 2024, they are under that amount. So they have significantly boosted their profits lately, which they have as they have become the primary seller for data centers. They have just dominated the chip market, specifically for data centers. And so this has been NVIDIA's competitive advantage. Before 2024, according to their research and development costs, they had a little bit of a red flag in terms of spending way too much money on R&D. But a red flag is not always something that I should eliminate a company for. I just want to see if they have lots of red flags. So NVIDIA currently looks good on paper. The next red flag that Warren Buffett looks for is related to a company's interest expense. So we can see right here, a little bit further down under operating income, we see NVIDIA paid $247 million in interest. Now, this looks like a big number, but once again, it's all in relation to something else. So in this case, we're going to compare their interest expense to their operating income. So here is an excerpt from the book. Okay, companies with high interest payments relative to operating income tend to be one of two types. Either a company that is in a fiercely competitive industry where large capital expenditures are required for it to stay competitive. So if this is a high percentage, it's a red flag. Not necessarily bad, because there are companies that have a high percentage that are still okay. And here he lays that out. A company with excellent business economics that has been acquired in a leveraged buyout. Sometimes that happens, and then therefore a company has a high interest payment as the new buyers are paying off their loan with the profits from the company that they bought. So there is, red flag, not necessarily a bad thing, but it is something that Warren Buffett looks for. In general, if a company is spending less than 10% of their operating income on interest, that's a great sign. If they're spending more than 30%, then that is a red flag. And also something else to consider, this is industry specific to some extent. So to do a little bit more due diligence, it would be better for me to also compare the interest expense percentage for NVIDIA with other companies in the same niche. Same goes for the research and development. It wouldn't really make sense for me to say that NVIDIA has bad R&D expenses if I'm not comparing them to other companies like it. If I'm comparing NVIDIA to Coca-Cola, these are two completely different business models. It doesn't really make as much sense. So it's important to do industry comparisons for a lot of these. If I go to my spreadsheet here, I can see for NVIDIA, their interest expense is incredibly low. In 2025, 0.3% of their operating income is spent on interest. This is pointing to the fact that NVIDIA is not highly leveraged. They don't have a lot of debt that they're having to pay interest on. So this brings down the risk, and it shows that they don't have to pull out debt to fund their growth. They're able to grow using their own profits. And that is what really points to a durable competitive advantage. The next red flag is related to a company's profits. This is pretty straightforward. He wants to see consistent and growing profits. And it's not enough to just look at the earnings per share. That's one of the indicators that is front and center when you're looking at the price of a company. You don't only care about earnings per share. I mean, that is important, but companies have ways to inflate their earnings per share while they're not actually growing their earnings over time. One way they can do this is through share buybacks. If a company is constantly buying back shares of the company, then they're reducing the number of shares. And in that way, the earnings per share will go up even if a company is not actually increasing its earnings. So the red flag that Warren looks for is, are the profits consistent and are they increasing? So if I look at NVIDIA, I can scroll down to the bottom here and see net income to common, 72, 29, 4, 9 billion, 4 billion, 2 billion. So a little bit choppy here at the back, but they have increased their earnings substantially in just the last 3 years. So that is really insane growth. The company that Warren Buffett is most known for, let's check out Coca-Cola. Something that tells me this company is going to be a little bit more steady and consistent, considering they're on the mature side, whereas NVIDIA is still a little bit on the growth side. So Coca-Cola, we see here net income to common, very consistent and lots of growth. The only exception here being in 2017, they had a bad year. But other than that, earnings have been going, which leads me to the next red flag, which is profit margin. It's important not only to see rising profits, but for the profit to be a high percentage of the revenue. And let me pull up an excerpt from the book here. Profit margin, a simple rule, and there are exceptions, is that a company is showing a net earnings history of more than 20% of their total revenues. There is a really good chance that this company is benefiting from some kind of long-term competitive advantage if they are constantly above a 20% profit margin. In the realm of 10 to 20, there are a lot of companies that could be having a competitive advantage, but if they are less than 10%, this is the red flag. Warren Buffett will eliminate companies, or at least look into it a little bit further, if their profit margin is below 10%. And on stockanalysis.com, if I scroll to the bottom, I see a profit margin consistently above 20% going back to 2019. And then they dipped, this is Coca-Cola, they dipped below 10% just 1 year in 2017. So something happened in 2017, but overall, Coca-Cola is incredibly consistent. And then the final red flag is the earnings per share. Warren Buffett does want to look at the earnings per share because it's important that a company is buying back shares and not having to constantly issue more shares. So if a company is increasing their revenue, increasing their earnings, but they're having to constantly issue more shares to raise funds, then that could point to the fact that maybe they don't have a competitive advantage. And Warren Buffett loves share buybacks. He likes them more than dividends, in fact, which a lot of people get backwards. People assume that Warren Buffett is crazy about dividends, but every time you get paid a dividend, you have to pay taxes on that. So Warren Buffett prefers the company to give that money back to shareholders by buying back shares, which increases the earnings per share of the company, which in turn increases the share price. So once again, if I look at the final breakdown, this is for Coca-Cola. This is all of my automated red flags. If it gets highlighted green, it's great. If it's white, then it's neutral. And then obviously if it's red, then automatically it's a red flag. And so right here we have gross margin Coca-Cola for the last 5 years in the green, percentage of SG&A, green, R&D. Oh, sorry. Is this Coca-Cola or is this another? Did I do NVIDIA? I did NVIDIA. So NVIDIA looking really good, but let me switch it to Coca-Cola. Okay. Coca-Cola, green, gross margins, neutral, selling, general, administrative, zero R&D. So that's great. Interest expense looks good. Profit looks good. That's profit margin. And then for profit and earnings per share, I have to look at the graphs here to see the trend. And both of these are trending up and to the left, which that's how I've got 2022 to 2024 going from left to right. Coca-Cola looks great on paper. If I want to see an example of a company that has a lot of red flags, then I would pull up just offhand Carvana. I'm sure Carvana has lots of red flags here. Lots of red on the screen. So here's an example of a company that I wouldn't even bother doing a deep dive on. It would save me a lot of time just to move on because there are so many red flags with Carvana. This is how I save a lot of time when I am looking to do a deep dive in a company. And the next step for me is to do a discounted future cash flow analysis. So the primary purpose of this automated spreadsheet is it calculates what is their intrinsic value based on their future free cash flow. After entering in the stock ticker, it automatically pulls all the information I need from stockanalysis.com, except for these values right here in yellow. I do have to enter in manually. And then I also have to enter in the analyst projections, which I have not done. So this is not going to be an accurate analysis for Coca-Cola, but I'm just showing it as an example. I have 5 different estimates for intrinsic value, and this is what I base my investments off of. Getting to this point takes some time. Using the red flags analysis helps me save a lot of time and eliminate companies that just have too much looking suspicious in their financials. And if you want to see an example of me using the discounted future free cash flow analysis, check out this video right here. And cheers. Oh, that's a good one. Jefferson's Ocean Aged at Sea. It's not salty. There's no seawater. It's just aged at sea. Pretty good.